All right, let's dive right in. In the huge world of dividend ETFs, there are two names that are always at the top of the list: Vanguard's VYM and Schwab's SCHD. For years, they've been the go-to choices for millions of investors. But a recent analysis suggests there's a pretty big shift happening right now.
Wow. Okay, now that is a bold statement. This is right at the heart of what we're talking about today. The author Tony Hicks isn't just suggesting a little portfolio tweak. He's basically calling for a total rethink of how investors should look at these two funds. And believe me, a call like that is definitely turning some heads.
So that's the big question, right? What's the deal? We're going to unpack the reasoning here, look at the hard numbers, and really get into the core philosophies that are apparently putting one of these funds way out in front of the other.
To really get this, we have to look past the ticker symbols. The real difference here isn't just the list of stocks inside these ETFs. It's the strategy, the actual rulebook each one follows to build its portfolio from the ground up. Here's probably the best way to think about it. VYM, it's like casting a giant fishing net. It's designed to just scoop up hundreds of high-yielding stocks without being all that picky. SCHD, on the other hand, is more like a super exclusive VIP list. It's not just looking for a high yield. It puts every single company through this tough quality check first. Let's dig into VYM's wide net a bit. It follows an index that brings in this huge portfolio. We're talking around 582 stocks. And the main rule for getting in is pretty simple. Does your stock have an above-average dividend yield? It's broad, it's super diversified, and the biggest companies get the biggest slice of the pie. It's a very straightforward way to own the high-yield market. Okay, now let's flip over to SCHD and see how its VIP list gets built. First off, it starts with a massive hurdle. A company has to have paid dividends for at least 10 years straight. No exceptions. Then it gets even tougher, using screens to check financial health, things like profitability and how much cash a company has compared to its debt. The end result? A much tighter, more focused portfolio of about 103 stocks. And just like VYM, it boots out REITs and also things called Master Limited Partnerships, or MLPs. So we've got these two very different playbooks. One is all about breadth, the other is all about quality. But how does that actually translate into results? Talk is cheap, right? This is where we get into the data and where the argument really starts to take shape. Before we get into all the performance numbers, let's get one thing out of the way right now: the cost. It's a dead heat, a total wash. Both of these ETFs charge an identical, and I mean very low, expense ratio of 0.06%. This is super important because it means neither one has a cost advantage. Any difference we see comes purely from their strategy. And here it is, the first major piece of evidence, and it is all about the income you get. The difference in the SEC yield between these two funds is a whopping 1.17%. I mean, for an investor who's focused on income, that is a massive gap. This chart just lays it out there in plain sight. You can see SCHD on the left clocking in at 3.74%, while VYM is down at 2.57%. Now, the 30-day SEC yield is just a standardized way to estimate the income an investor can expect over the next year. And right now, it's pretty clear that SCHD's focus on quality is delivering a lot more cash flow. But what about the long game, total performance? Well, over the last decade, SCHD has also kept a small but pretty consistent edge. Look, it's not a huge blowout, but an 11.1% return every year compared to 10.47%, that really starts to add up over time. So the key point here is, for the exact same fee, SCHD has been giving you slightly better total returns and a much higher current yield. This focus is a direct result of that selective VIP list strategy we talked about. A massive 41% of the entire fund is tied up in just its top 10 holdings. This means it's a high-conviction portfolio. When those top companies do great, the fund really flies. Of course, the flip side is that there's also more risk tied to any single stock. Now compare that with VYM. Its wide net approach means that risk is spread out a whole lot more. The top 10 companies only make up about 25% of the portfolio. This is that classic diversification argument, right? You get a much smoother ride because no single company can have a huge negative impact on the whole fund. This little table gives us a great side-by-side snapshot. You can see that huge difference in the number of holdings, over 500 for VYM versus about 100 for SCHD, and you can see they're betting on different sectors. But the real takeaway, the whole story, is right there in the bottom two rows. For the exact same 0.06% fee, SCHD is delivering a way higher yield. This is the entire argument in a nutshell.
Now, to be clear, the author isn't saying you should run out and sell all your VYM tomorrow, especially if you're sitting on big taxable gains. It's not an obsolete fund by any means. There are still some really valid reasons why an investor might actually prefer its approach. So let's look at the case for Vanguard.
So, who should stick with VYM? Well, according to this analysis, it's for the investor who really truly values diversification above everything else. Someone who wants to minimize the risk of any one company blowing up. It's also for someone who just wants a simple, no-frills way to own the entire high-yield space. Or maybe someone who's making a specific bet that sectors like financials are about to have a big run.
Okay, so after weighing all the evidence and considering the counterarguments, we come back to where we started. Let's tie it all together and summarize exactly why the author believes SCHD is the better choice for any new investment dollars you have. It really boils down to these four things. First, that income advantage is just undeniable today. Second, those quality screens act like a guardrail, designed to filter out companies that might get into trouble and have to cut their dividend. Third, you get slightly better long-term returns for the exact same price. And finally, with a more focused portfolio, you just have a much clearer idea of what's driving your performance.
And this quote from the article just wraps it all up perfectly. When you can get a higher payout right now, a portfolio that's been screened for financial strength and slightly better historical performance, all for the same low fee, well, the author argues that just makes SCHD the better bargain in today's market. Simple as that. And that leaves us with this final thought. The choice between VYM and SCHD, it's not just about the numbers on a screen. It's really about your own personal philosophy. It kind of forces you to ask yourself what you really value as an investor. Is it the comfort and safety of casting that wide net? Or is it the potential rewards that come from using a focused, quality filter? Definitely something to think about.